Imagine this. You wake up, you check your phone. Bitcoin is down 10%. Ethereum is bleeding. Altcoins look like a crime scene. No hack, no exchange collapse, no crypto ban headline. Just one sentence from a central banker spoken thousands of miles away. That's the uncomfortable truth most crypto investors don't like to admit. Crypto doesn't crash because of code, it crashes because of money power. And tonight, we're going to unpack how a single central bank decision can wipe billions off crypto markets overnight, quietly, legally, and predictably. Not with jargon, not with charts, with a story. Because this matters right now. Over the last few years, crypto promised freedom from central banks, no control, no printing, no suits deciding your future. And yet, every time a central bank speaks, crypto holds its breath. That contradiction is the entire story. Let's start with a scene you've probably lived through. It's a normal trading day. Crypto is calm, sideways, boring even. Then a notification hits. Federal Reserve signals rates will stay higher for longer. Within minutes, prices drop, liquidations cascade, Twitter explodes, and everyone asks the same question. Why does crypto care? There's no CEO, no earnings report, no factory. So why does one policy decision flip the entire market? To understand that, we need to talk about what crypto actually runs on, not code, liquidity. Liquidity is just a fancy word for how much easy money is floating around, ready to move. When money is easy, people take risks. When money is tight, people run. And central banks control that switch. Here's the simple version. Central banks set interest rates. Interest rates decide how expensive money is. Expensive money kills risk. Crypto is pure risk. When rates are low, borrowing feels harmless. Funds borrow cheap dollars. Retail investors swipe credit cards. Companies gamble on growth instead of profits. Money sloshes everywhere. Crypto thrives in that environment. But when rates rise, the math flips. Expensive costs hurt. Safe assets start paying real returns. Suddenly, parking money in cash isn't stupid anymore. And crypto loses its biggest advantage, excitement. This is where the hidden mechanism kicks in. Most crypto buying doesn't come from people investing spare savings. It comes from leverage, borrowed money, margin, loans backed by other assets. When central banks tighten policy, leverage gets squeezed. Funds that borrowed cheaply now face higher costs. They need to reduce risk fast. What's the fastest thing to sell? Not factories, not private companies. Liquid assets, stocks, crypto, anything that trades 24/7. Crypto is the easiest exit door in the building. So when a central bank tightens policy, funds don't debate philosophy, they hit sell. That's step one. Step two is where things get ugly. Crypto markets are thin compared to traditional finance. That means fewer buyers at each price level. When big players sell, prices drop fast. That triggers liquidations, forced selling, not because someone wants to sell, but because they must. Positions auto-close, more selling hits the market, prices drop again. It's not panic, it's plumbing. And this can all happen within minutes of a central bank statement. No crypto news required. Here's the part no one likes to talk about. Crypto didn't escape the financial system. It plugged directly into it. Look at who moves markets today. Hedge funds, trading desks, macro investors, ETFs. These players don't believe in decentralization. They believe in spreads, volatility, and exits. Crypto became just another high beta asset. When central banks tighten, they reduce exposure. When central banks loosen, they pile back in. Belief is optional.
Liquidity is not. There's an irony here that's almost funny. Crypto was built to avoid central banks, but its biggest bull runs happened because of them. Think back. After the 2020 crash, central banks flooded the system with money. Rates near zero, stimulus everywhere. That wave didn't just lift stocks, it poured straight into crypto. NFTs, meme coins, yield farms promising the impossible. It felt like a revolution. It was actually excess liquidity looking for a home. When that liquidity left, the party ended, not because crypto failed, because money changed. This is the uncomfortable math most hype ignores. Crypto doesn't compete with fiat systems yet. It competes with interest rates. If safe assets pay 5%, speculative assets need to justify risk. Most can't. So when a central bank hints at tighter policy, even slightly, crypto prices react violently. Not overnight by accident, overnight by design. Because crypto trades globally, instantly, without circuit breakers, while stock markets sleep, crypto doesn't. That makes it the first asset to absorb shock. Central bank speaks at 2 p.m. New York time. Crypto reacts immediately. By morning, headlines blame market fear, but the decision was already priced in hours ago. Now zoom out. Why does this matter beyond price charts? Because this dynamic creates a dangerous illusion. People think crypto crashes are unpredictable. They're not. They follow money conditions. And as long as central banks control global liquidity, crypto volatility is their shadow. Even if crypto becomes more decentralized technologically, financially, it still breathes the same air. That doesn't mean crypto is doomed. It means expectations need adjusting. Crypto isn't immune to power. It just responds faster to it. The real risk isn't a ban. It's a boring policy meeting. A few words, a dot plot, a pause instead of a cut. That's enough. So the next time crypto crashes for no reason, ask a different question. What did money just become more expensive to do? Borrow? Speculate? Wait? Because the answer usually isn't in the blockchain. It's in a conference room with bad coffee and carefully chosen words. And here's the thought I'll leave you with. If one central bank decision can crash crypto overnight, what happens when they all move at once? That's not fear. That's unfinished math.